Good morning, dear students. Today we are discussing the Unit 4 Bank Reconciliation Statement. What is bank reconciliation statement? It is a statement prepared by the customer himself for if there is any variations in between bank column of the cash book and bank passbook. So in order to rectify the changes or the difference between these two books, the customer himself prepares the bank reconciliation statement. So what is the meaning? Bank reconciliation statement is a statement which is prepared to reconcile the difference between the bank balance as per the cash book and the bank balance as per the passbook. According to Bartley Boy, a bank reconciliation statement is prepared at periodical intervals with a view to indicate the items which cause disagreement between the balance as per the bank column of the cash book and the passbook balance on any given date. So this is bank reconciliation statement. What are the features of bank reconciliation statement? So the major features are, first one, it is a statement and not a ledger account. So normally this is a statement, this is treated as a statement, this is not treated as ledger account. It is prepared periodically, same means weekly, fortnightly, monthly, quarterly, half yearly or yearly depending upon the volume of banking transactions. Generally, it is prepared at the end of every month. The businessman or the customer prepares that bank reconciliation statement every month. It is prepared by the bank customer and not by the banker. If it is not a part of books of accounts, it is prepared on a sheet of paper outside the books of the accounts. Instead of ledger accounts, we are preparing it is in a separate sheet of paper. It is prepared only when there is difference between cash book balance and the bank passbook. It is prepared to verify the accuracy of entries made in the cash book and in the passbook. Then, there is a need? What is the importance of bank reconciliation statement? Both the cash book and the passbook contain the same banking transactions. So the bank balance as per the cash book and the bank balance as per the passbook should agree on any particular date. However, in actual practice, the cash book balance and the passbook balance do not tally. Hence, ascertain the causes of difference first and then reflect them in a statement called a bank reconciliation statement to reconcile the differences between these two balances. That means bank column of the cash book and the passbook balance. So why these accounts shows difference in balances? That may be due to the timing differences. The differences due to majorly two causes are there. The first major cause is timing differences on recording of the transactions, and second one is errors made by the business or by the bank. So what is timing difference? The timing difference means when a business compares the bank balance of its cash book with the balance shown by the bank passbook, there is often a difference, which is caused by the time gap in recording the transactions relating either to payments or receipts. The factors affecting the time gap includes check issued but not yet presented for payment. That is one of the reason between disagreement between these two balances. Second one, check deposited into the bank for collection but not yet collected. So that is another reason for disagreement between the balances between cash book and passbook. Then direct debits by the bank, amount directly deposited into the bank account by third parties, interest and dividend collected by the bank, direct payments made by the bank on behalf of the businessman, check deposited, bills discounted, dishonored. These are the timing differences between the balance between there is difference between the balance of cash book and bank passbook. Second one is caused by errors. Sometimes the difference between the cash book balance and the passbook balance may arise due to an error made by the bank or the business in its books. Example of such errors are wrong debit, wrong credit, undercasting, overcasting, etc. Errors made by the business in the cash book and errors made by the bank in the passbook. These are the reasons for disagreement between the bank column of the cash book and balances of the bank column of the cash book and a passbook. Then the next topic is rectification of errors. So there may be some types of errors in accounting. The first one is, what is error? Error in accounting means unintentional mistakes committed by the bookkeepers in the books of accounts. So what are the type of errors? Errors in accounting can be classified on two bases, namely on the basis of the nature of the errors and on the basis of their effect on the agreement of the trial balance. So on the basis of the nature of the errors, first one is error of principle. What is error of principle? Instead of correct entry, we are posting a wrong entry, that is known as error of principle. So accounting entries are recorded as per the generally accepted accounting principles. If any of these principles are violated or ignored, errors resulting from such violation or ignorance are known as errors of principle. An error of principle may occur due to incorrect classification of expenditure or receipt between capital and revenue. Example, if we are selling an old furniture for rupees 10,000, the correct entry is furniture account added to cash. But instead of that, they are posting cash account added to sale. That is a wrong entry. So that is the, for example, of error of principle. Second one, the error of omission. If the transaction is completely not recorded either at the time of recording the transaction in the book of original entry, nor while posting to the ledger, such errors are termed as error of omission. Here we are completely ignoring one transaction, that is known as error of omission. If, for example, a credit purchase of goods from Madan rupees 15,000 has not all been recorded in the books of account, that is, we are completely ignored that transaction. So that is error of omission. The third error is error of principle. Error of commission. An error of commission refers to an error due to some clerical mistakes. Error of commission take place when some transactions are incorrectly recorded in the books of accounts. For example, recording a wrong amount in the subsidiary book, posting twice or thrice to an account, wrong totaling of the ledger, wrong carry forward, etc. are the examples for error of commission. And the last error is compensating error. Some errors are compensated by other transaction. So compensating errors are errors which compensate or neutralize the effect of each other. So, if purchase book is undercast by rupees 2,000 and sales book is undercast by 2,000, that is neutralize that transaction. So, that is one of the example for compensating error. If rent account is overcast by 500 and wages account is undercast by 500, that's also an error of compensating error. Then next one, second reason is on the basis of their effect on the agreement of trial balance. So these are the above four are the journal entries or ledger account problem. The next one, the agreement, their effect on agreement of trial balance. Sometimes the first one is one-sided errors or errors disclosed by the trial balance. So one-sided error refers to an error which affects only one aspect, that is either debit aspect or credit aspect of a transaction. Posting a wrong amount to the wrong side of the correct ledger account, that is wages paid as 720, are credited to the wages account as 270. So that is a one-sided error. So posting an item twice to the ledger account, that is insurance premium paid debited to insurance account twice, that's also one-sided error. Sometimes it may be two-sided errors or errors not disclosed by the trial balance. A two-sided error refers to an error which affects the aspects, that is debit aspect as well as the credit aspect of the transaction. Error of principle is, that is, furniture purchased from Arun was recorded in the purchase book. That is an example for two-sided error. So that is furniture is purchased from Arun, that is recorded only in, recorded in purchase book. So it will not be reflected. The next one, how we rectify these errors. Means correction of mistakes found in the books of account. The next is the bank reconciliation statements format. So the first one, bank balance as per cash book or bank overdraft as per the passbook. We add all the transactions increasing cash book balance. Then we should deduct total of transactions decreasing the past cash book balance. We get bank balance as per the cash book. Thank you.